We've got bonds lower heading into the meeting, not even waiting around to hear from the Fed chair. The trend of higher yields continues. Michael Shaoul joins us, Chairman, CEO, and Portfolio Manager at Market Field Asset Management. Michael, welcome back to the show.
Good morning.
So let's talk about this move first. Mike, I know you're a long-term guy. You think big picture. But what the heck? We're already rallying yields and down in bonds ahead of this FOMC. Is this a very nervous, panicky market? What should we think about this?
No, I think there's a persistent outflow from long duration treasuries, I think ahead of what people anticipate is going to be a very strong summer for growth. And the risk of some significant inflation being attached. The question is not really what is the Fed going to say, but more what's the market going to react to it. I think we have, it's a reasonable assumption that Jay Powell is going to defend current Fed policy. I think the Fed is going to echo the comments coming out of the Treasury and Janet Yellen, but the idea that, we will see definitely a big base effect in inflation, and we may see some direct inflationary effects from reopening, particularly in the service sector, but that this is going to be a transitory, that it's going to come and it's going to go. And in 2022, things are going to be back to normal. And if we average inflation out between 2019, 20, 21, everything's going to look just fine. I personally think that is a much too optimistic view of the world. I do believe in the unintended consequences of policy. And generally, the size of the unintended consequence is correlated with the size of the policy. So, we've just enacted a record fiscal stimulus at a time that the U.S. economy, really is doing okay. It's apparently politically incorrect to do so, but outside of sectors directly affected by COVID, the economy is doing fine. So I think the last thing we needed was a very large, very broad stimulus. And frankly, monetary policy looks increasingly out of whack with what's happening in the underlying economy. It's just become necessary to keep the nerve of the financial markets intact. And so, you put, the scale of activity on the stimulus side, into historic context. I think we have a recipe here for the kind of unintended consequences that we haven't seen since the late 1960s, which was really the last time that the U.S. shifted out of a very long period of persistent low inflation. It wasn't viewed as a problem at the time, unlike today, and ended up in a period of much stickier and spikier inflation than anybody had thought was possible.
When do you think we might see some of this in earnest, where we know that the comparables for inflation are going to be very easy to create some big numbers here over the next couple months, but what to you will be early evidence that they are actually sticky and this is not something transitory?
Yeah, well, it's obviously going to be about the month-over-month increases, not the year-over-year increases. A year-over-year increase that simply tells you went down a lot in March, April, and May, isn't going to be, very interesting. But if you look at sort of where PPI and where import and export prices are, they're already up year-over-year in February. So that's pre-COVID. So, on the input side, we already have evidence of inflation, what we tend to call reflation, because it's only on the input side. The question is going to be on the output side, at the CPI and PCE level. Are we going to see parts of those indexes really break out to new highs above their levels where they were pre-COVID, and are they going to be able to accelerate from that point on? I think they are. I mean, certainly on the physical side of the economy, not just food and energy, which will get stripped out of core, but anything to do with the manufacturing and sale of physical goods looks to be straightforwardly inflationary at this point in time. And my assumption is that the reopening of the service sector, which I think is going to happen very, very, very rapidly, is going to happen at a time of tremendous excess savings. The pricing power of the leisure and hospitality industries, which is where the real deflation is lurking in the data, the pricing power is going to be remarkable. I really think we can see some quite gaudy month-over-month increases in that sort of May through September period. And then the big question is going to be, is this just a flash in the pan, which kind of comes and goes, and you sort of undershot pricing power this year, last year, and you're going to overshoot it for a few months, and then you're going to go back to some kind of normal equilibrium, or have we simply shifted into a period of higher inflation expectations and greater pricing power at the corporate level? And as I say, frankly, I've anticipated the latter for a few years, and it hasn't happened yet. But you keep on adding zeros to the numbers. The odds of it happening, go up and up and up.
So the odds of it happening, I think, are a very interesting thing to consider in the context of a bond investor right now, where it just seems that even if we don't know if it's transitory or sticky yet, that the kind of pot odds of being long bonds are very unfavorable to being short bonds in this period. And so that leads me to wonder, Michael, how in maybe just the next, call it 5-6 months, 3-6 months or so, if we're going to need anything concrete on the inflationary front to justify the move in yields, or if yields will continue to go basically until there's some counteracting force by the Fed. Because it seemed last time Jay Powell spoke, when as soon as he said that I'm not worried about the yield move, bam, that's exactly on the moment where we had yields spike again and markets dropped. Are we learning something here about what we need from Powell to stop the move?
I think in terms of the way the bond market prices inflation expectations, those numbers look quite high. But if we simply look at nominal yields, and as I say, I'm a fairly simple guy at the end of the day, I like to look at the nominal 10-year yield and where it is versus inflation. And it's roughly normal. The 10-year yield is only slightly above CPI year over year. And over the last decade, which is this really when we've had deflation or low inflation from 2011 onwards, the 10-year has typically been in a range of minus 100 to plus 100 basis points, versus headline CPI year over year. So I think the bond market's only neutral. I think what the bond market has done is reprice away the risk of deflation. From this point on last year through the summer, the market took a very deflationary view. And even though the equity market, S&P got back to 3,000, 10-year yields were still hovering around the sort of 50, 60 basis point level, towards the end of last summer. Since that time, yields are up maybe 100 basis points, but all that's done is reprice away deflation. There's plenty of room for the long end of the curve to move higher. Frankly, even if CPI was only in the low twos, a 10-year in the twos and CPI in the twos, wouldn't be, you wouldn't say yields were quote unquote too high. They just look uncomfortably high for anybody who'd sat long bonds for that period of time.
Michael, with the Fed's relationship to the bond market, we don't really know quite yet if there's a pain threshold that will be reached. I've had folks on the show say that they will expect twist talks to begin around 1.75%. Do we have any idea, or do you as an investor have to think about where potentially the Fed would step in? Do you want to wager when that might be?
I don't think it's necessarily a yield level. I think the two things the Fed's going to care about is, number one, the quality of Treasury auctions. Remember, the Fed cannot buy in a Treasury auction, and the Treasury needs to be able to issue very large amounts of bonds to fund the deficits that we're going to see. So quality of Treasury auctions, bid to cover ratios, reactions of yields around auctions, very, very important. If they start to get messier than they are today, I think the odds of twists go up. And the other is going to be broad financial conditions. If we start to see credit spreads suffer as yields move higher, which has not happened at all so far, it's been the opposite so far, then again, I think the odds of twists go up. The next point I'd make is the reaction of the market to twist is very important. Does the long end of the curve respect what the Fed does? If the long end of the curve does the dollar take the hit? For investors to say, look, the Fed is going to make sure that you get undercompensated for the inflation risk by Treasury yields. By definition, that's effectively what twist is doing. Do you still want to be long the dollar at this point in at this point in time? Do commodity markets go nuts in response to something like that? So as I say, it is the idea of the Fed being all powerful It's true at certain points and less true in others. The Fed is very, very powerful in a position that we had last March, where everybody's selling everything and spreads have blown out wide, and financial markets are in chaos. The Fed is very, very powerful in that kind of a situation. It is much less powerful when the facts on the ground are what's driving the market higher.
So the ability to suppress rates maybe being an easier one, obviously when the economy is in trouble, as opposed to trying to prevent it when things are heating up. Michael, from an investment standpoint, obviously, I've talked to home builders a lot, which has been one of the big trades you've been very correct on. I know last time around you mentioned that some of the tailwinds, particularly here for rates, might start to ebb somewhat, but is that still a trade that makes sense if you're talking about potential for the Fed not controlling that long end and yields rising and maybe making that way into mortgages at some point?
Yeah, we haven't seen any problems yet. So far the mortgage rates sort of got rid of about half of the Treasury increase, and you do also have a possibility. In the early 2000s, when yields moved higher, people did shift into variable rate mortgages, and assuming the Fed keeps the short end very low for a very long period of time, which I think is a given. Variable rate mortgages would be possible. We would have some concerns about margin pressures. So far, the builders have been able to pass those costs on. So they say, I think housing's gone from a must-own to a can-own. What we would favor, in addition to housing, is just broad cyclical exposure. Very broad exposure to commodities in general, not just industrial, but agricultural and energy. The people who supply the tools to dig it out of the ground, the people who supply the logistics to transport it, the manufacturing of physical goods, and the selling of physical goods. I think it's the physical goods economy looks really, really powerful on a global level, and the big risk going forwards is a combination of critical shortages of components, semiconductors being one obvious one. And logistics and pricing pressures getting in the way of margins. But the demand side for that kind of stuff looks remarkably strong. Okay.
Michael, always good to get your thoughts here. Appreciate you joining us and looking forward to catching up post-Fed. Thanks a lot.
Thank you.
Michael Shaoul is the Chairman, CEO, and Portfolio Manager at Marketfield Asset Management.